Welcome, everyone, and thank you so much for joining us today. With less than 30 days left until the election, the news cycle is moving at breakneck speed. It's hard to keep up if you honestly choose to do so. And this afternoon, we want to spend some time digging into one important aspect of the upcoming election: the effect the different outcomes could have on the real estate industry from the standpoint of tax implications on the ownership of real estate. This is obviously a really nuanced topic and hugely important to our industry and to our work. So we're thrilled to have some of our expert partners here with us today. Ed Reitmeyer of Marcum Accountants and Advisors, Wendy Coatson of Ballard Spahr, and Ed Leva from the Villanova School of Business. And they're going to bring us perspective and understanding on this nuanced topic. After all, who doesn't love talking about taxes for an hour? But before we jump into that panel discussion, I thought I'd take just a few minutes to give a quick update on what Berkadia is seeing in our business, in our portfolio, and in the market right now. I'll then turn it over to our CFO, Randy Jensen, who will host our panel of esteemed experts on the topics of the election and CRE tax ramifications. So to start out with some Berkadia observations, I'm going to focus my commentary on the multifamily sector of the commercial real estate market, because honestly, that's where we're seeing the highest levels of activity and liquidity. When we look at it from a mortgage banking perspective, rates and pricing have honestly never been better. The 10-year Treasury is at a historic low, and when the last time I looked this morning, we were at a 77 basis point 10-year. And remember, we started the year at a 188. Additionally, the spreads on agency guaranteed bonds like Fannie, Freddie, and HUD are the tightest they have ever been, despite softening a little bit in recent weeks. A 10-year interest rate on agency 10-year paper is generally a sub 3% all-in rate. It's closer to 2% depending on your leverage level. For example, higher leverage is at or around 3%, and lower leverage is closer to like a 225 right now. Through the first 3 quarters of 2020, Berkadia has originated almost $18 billion in volume for our clients across our various lender programs, and this is less than 10% behind where our 2019 year-to-date volumes were. We are seeing an increase in activity in the market right now, obviously, from what we saw in the early months of the pandemic. And right now, about 40% of our deal pipeline is new acquisition activity, which is much closer to our percentage numbers. Our HUD originations are up almost 200% from last year, and our HUD pipeline remains the strongest it has been in our company history. We remain a top Fannie Mae and Freddie Mac lender, and we're seeing really consistent and strong liquidity from both agencies, which is providing stability to the multifamily market. They have over a 50% market share right now for originations. But we also continue to leverage our large network of non-GSE lenders, including banks, CMBS, and life cos, and we have over $2.5 billion in origination with these partners year to date. Now, when we look at the investment sales side of the business, apartments were the largest sector for transaction volume in August, no surprisingly. It accounted for 40% of all commercial real estate sales. But still, the $5.5 billion in apartments that traded is a low figure compared to recent years, and that was down 65% from the same month a year earlier. Though this current activity may seem a little low and shocking, we have to remember it could be worse. The multifamily deal activity has actually averaged about $5 billion a month from April to August. And if we look back as a comparison to 2009, in the worst parts of the Great Recession, deal activity was averaging less than $1.5 billion a month. So we need to look on the bright side still. And over the past several months, when we look at multifamily investor demand, it's really been driven by the resiliency of the asset class and the historically low interest rates I talked about earlier. The cost of capital obviously remains unbelievably attractive, which is allowing investors to become more aggressive on pricing. In many cases, we're seeing pricing at or near pre-pandemic levels. In September alone, Berkadia completed nearly $750 million in multifamily sales, and we're cautiously optimistic that this investment activity is going to remain steady for the remainder of 2020. When I look by asset class, Class B multifamily product has shown greater resiliency than Class A or Class C, and as a result, there's a surplus of capital that's actively targeting these stable workforce housing, income-producing Class B product. And they're continuing to push the envelope on pricing to new highs. Buyers thus far have been predominantly private investors. They've made up nearly 90% of the purchasers for our current listings and the deals that we have in escrow. As we're seeing, many institutional investors are still kind of waiting on the sidelines for more confidence and a little more clarity on the market. Investment activity geographically has been fairly consistent across the nation. It's not isolated to a few specific markets. In terms of our sales production, Texas, California, and Arizona have been our most active markets. I think all of us have been reading housing market dynamics have been altered by the coronavirus, and there's been a noticeable shift in renter preferences towards more affordable Sunbelt markets like Texas, like Georgia, North Carolina, South Carolina, Tennessee, Arizona, and even I would add Utah now, in addition to an increase in suburban communities. And this kind of compares to what we've heard and read in the news that the gateway cities have been the hardest hit by COVID, and the data does support this. The most extreme example is San Francisco, where occupancy is 92.6%. It's down 410 basis points year over year, and asking effective rent in San Fran is down almost 13%. New York City, occupancy is 96.6%. but it's down 120 basis points year over year, and effective rent is down 10%. So, these are the trends that we're watching across the country. But beyond the property level kind of geographic returns investors are looking at, they're closely monitoring the changes in spreads between cap rates and treasuries. Today, we're witnessing an approximate 450 plus basis point spread between the average multifamily cap rate and the yield on the 10-year treasury. And this suggests investors are demanding and getting a higher risk premium. And you can compare this to, the tightest we ever saw in the market in 2007, and the spreads between cap rates and the yield on the 10-year treasury were a mere 100 basis points. So from a relative value standpoint, multifamily is still extremely attractive. If we pivot a little and we look on the servicing side, Berkadia is a highly rated, and we're a diversified commercial real estate servicer. We have an almost $300 billion commercial real estate portfolio with 20,000 loans. And I think the performance of this portfolio over the last 6 months is indicative of the general commercial real estate performance that we're seeing. And so I thought it would be helpful to share some highlights that we've gleaned from our experience monitoring the portfolio and provide these as comparisons across some asset classes. When I think way back to March and the initial news reports and even the projections about the coronavirus and the impact that it would have on commercial real estate, and in particular in multifamily, we prepared for the worst. We adjusted our teams internally to make sure we had the right mix of talent in order to address what we knew was going to be an influx of problems related to the spread of COVID-19. And like so many others on this phone call, we all began to work remotely. And so for March, we finished the month with a collection rate on the portfolio of 99.5%, with the multifamily rate being 99.6%. And we determined that March date would serve as our baseline for the defaults and delinquencies that were predicted to follow. And just for clarity, when I refer to collection rates here, it really is with respect to the percent of borrowers who have made their monthly payments to us as servicer. This isn't a statement about the tenant receipts to the borrowers. But at the start of April, we were ready. We had forbearance teams staffed and we had templates prepared, and the inquiries did start to roll in, but not at the pace we expected, to be perfectly honest. We finished April with collection rates of 98.4% for multifamily. So granted, it was a 1.6% shortage on monthly collections. That still translates into billions of dollars in loans that had not made their April payment. But again, thankfully, it fell far short of what our worst case scenarios were. And in fact, over the following 5 months, the worst month for multifamily collections was 97.1%. And so by way of comparison, healthcare and hospitality property types went from 99% collections in March to 89.8% and 77% collection rates in September, after 5 straight months of continued stress and decline. And the retail property type also has shown some stress, and we're seeing collections in the mid-90s during this period. So, a takeaway here is that multifamily has performed very well. When we dig a little deeper into our Fannie Mae and Freddie Mac books, we have Fannie Mae collection rates over 99%. So to me, these Berkadia performance numbers demonstrate that despite the massive economic disruption that we've seen in 2020, the multifamily real estate market has so far been a bastion of stability. And this bodes well for the future, but we need to be prepared. We believe that the demographics and the market demand will remain strong for rental housing, but we're monitoring the market fundamentals, and we're looking at new construction and supply in certain markets and unemployment rates for any softness and areas of weakness. We obviously expect to see some volatility as the 2020 presidential election is less than 30 days away. And so it's critical that we remain nimble, we keep our options open, and we await the true impact of these world events. So with the stage set for what we're seeing in the debt and equity and acquisition markets, as well as some overall market trends we're tracking, let's get to the meat of our program. And I would like to turn it over to Randy Jensen, our CFO, who's going to introduce our panelists and get the discussion of the tax consequences of the 2020 election started. So take it away, Randy.
Thank you, Hillary. Appreciate that. And thanks to all of our great customers and friends that have joined us today. We're thrilled today to have 3 industry experts and trusted partners to help us think through what may lie ahead with respect to taxation. I'll start with some brief introductions of our highly esteemed experts, and then we'll jump right in. First, we have Wendy Kotzen. Wendy is a partner in the law firm of Ballard Spahr, where she is the practice leader of the tax group. She advises customers in taxation of all types of real estate transactions and has deep experience and expertise in working with all types of real estate entities, partnerships, REITs, and other like entities. We also have Ed Leva. Ed is a professor of practice at the Villanova School of Business, where he teaches partnership taxation and advanced topics in taxation in the Master of Taxation and Data Analytics program at Villanova. He retired from KPMG in 2015 as a partner following 38 years in the profession. And finally, we're joined by Ed Reitmeyer. Ed is a Mid-Atlantic regional partner in charge of tax and business services at Marcum Accountants and Advisors. He has over 30 years of public and private accounting experience in the real estate industry and in providing integrated taxation, transaction, and advisory services to all the different flavors of owners, lenders, developers, and users of real estate. This is a truly exceptional panel of experts. I want to thank Wendy, Ed, and Ed for spending your time with us today. And we're excited to gain some insight from you as we look at this. This is a very interesting time as it relates to tax policy, given the very stark differences in the proposals and philosophies of the Republicans and the Democrats. Ed, Reitmeyer, perhaps you could start us off by helping us think about some realistic assessments of the environment we face as taxpayers in the real estate industry. And Wendy, Wendy, why don't you start us off? We're having
Okay.
some technical difficulties with Ed Reitmeyer.
Great. So you can hear me, just confirm that. Yes?
We hear you.
Great.
Yeah.
And just for everyone's benefit, I was going to change my name to Ed for today too, as well, just to make it even more complicated. So what Ed was going to tell you, and hopefully he'll be able to get back in, is tax policy is a aggregation of a whole variety of different inputs, and even more in perhaps the oddest year we've had in recent memory, 2020. We've got the pandemic and all the economic and other fallout that results from the pandemic. We have the presidential election where we have basically very differing views of policy and the right approach to take for tax. We have what's going on in the congressional elections with people on both sides not necessarily agreeing with everyone on their own side. And we have the Tax Cuts and Jobs Act, which was passed at the end of 2017, which still is working its way through the system. That still creates some uncertainty for those of us tax professionals. One of the things that we've been doing is learning what that act says and what it means. And one of the issues that happened with that act is the Congress was in a hurry to get it done. And as a result, not everything was written as clearly as one would hope, so that it could be applied appropriately. And still, we're working our way through, and as is the IRS and Treasury, to interpret a lot of things. So all those things have to work together. I mean, to get a tax law passed, regardless of who's president, you need Congress, both houses, to pass a law and send it to the president for his signature. The way tax legislation frequently works is that Treasury works with the tax writing committees to get tax law done and so forth. So if we have, like we do now, different control in at least one house, if not both, of Congress than the president, then compromise has to be reached to make any changes. Ed Leva, if you want to start on the next question.
Welcome, Ed Reitmeyer. Appreciate it.
Sorry for the technical difficulty there.
Just one quick follow-up, right? So we're entering this period where there may be a change. Assuming there is a change in the presidency or the Congress, what would you expect would be a reasonable time frame under which changes could be made and an implementation date? The Trump tax cuts were put in place effective for 2018, a year after he was in office. What are your thoughts?
So Hillary really spoke well about this when she tied some of the market analytics back to 2008, 2009, right? So at that time, we had this huge recession that was going on. So, as time goes on, we're going to have to see really what the economic fallout is, right? That's one of the four big legs of the table. And Wendy went through, some of the politics with the House and the Congress. So if you take a look back, it took some time when you had a changeover of administrations back in 2008, and then it took Trump a decent amount of time when he had both the House and the Senate. And as we discussed, some of the gateway cities having some issues, and maybe in some of the market, those gateway cities have congressmen and they have senators, and they're all going to vote the way that their constituents are going to either demand it or such. So it's not easy to herd that group in Washington together to get the bill passed. And in fact, one of the issues with the Tax Cut and Jobs Act was that there was a kind of an error in the bill in the way that they produced it. And we'll talk about this a little bit later. And it required a technical corrections. And that wasn't going to happen politically. We needed to really have a pandemic in order to solve that technical corrections issue, and that happened in the CARES Act. So again, I apologize for my technical difficulty there, and didn't mean to step on Ed's toes.
Ed, and certainly it took till the Tax Cut and Jobs Act was signed into law on December 17th, 2017. So it took close to a full year for a reasonably unified government to get that done. And even within that, there were obviously disagreements among the Republicans as to exactly what should be in there and what ultimately emerged. It was prospective with a phase out. Almost all the individual benefits phase out and they're gone and they sunset in 2026. And the reason for that was the thought that if they make the business cuts permanent and the individual cuts phase out, there'd be intense pressure to extend them. For the most part, not entirely, tax changes have been prospective and not retroactive. But we'll see what happens.
Right. So if we look back at some of the acts, maybe going back to '86, I think they all will have an effective date at some point in time. So I agree 100%.
Okay. Any additional comments, Ed Leva, you'd like to make on that?
Yeah, maybe I can just fold them into what I was going to start saying a moment ago. And let me just do a mic check here. Can you hear me?
We hear you.
Good.
Perfect.
All right. So why don't we just, consistent with what we were just talking about not only the process, but the content of the acts, let's do a high level flyover in terms of what we're looking at here. Just initially, what we have to realize is the comments that we're making about Trump's position is really just based on either comments he's made or speculation based on how people feel he would go. In other words, there is no formal Trump plan that has been published or documented, although he has been adamant in saying that he would like to decrease the capital gains rate. So we'll add that into the mix here. The Biden plan, however, is actually a documented plan, but it's important to recognize that, as Wendy was referring to, the process of tax legislation, it generally starts in the House with the House Ways and Means Committee, then goes to the Senate, and then ultimately signed by the president. But historically, with most of our recent tax legislations, presidents and the administration do float a plan out there that at least signals to everybody what they would like to see. So that's what we're looking at now, a Biden plan that was documented and posted so that everyone can see which direction they would go at. And then also, just from a big picture, let's dive down into the Biden plan, and then we can come to capital gains. But this plan right now is projected to raise $4 trillion of taxes over the next 10 years, which coincidentally is very close to the amount of the total tax cut that the Tax Cut and Jobs Act had just a couple years ago, which was a $3.5 trillion tax cut over that same period of time. The roughly $4 trillion that the Biden plans will raise comes roughly half from new corporate taxes. So just three main ones on the corporate side of the transaction. They're going to take the corporate tax rate from 21% to 28%. You may recall that that was just recently dropped from 35 to 21. They're going to impose a 15% minimum tax on book income and increase foreign profit taxes. So all said and done, roughly half of the $4 trillion comes from corporations. The remaining half comes from individual taxpayers, mostly high net worth individuals. And we're going to be talking about a few of those, but the very largest piece, approximately $1 trillion, comes from increases in Social Security taxes by virtue of raising the cap rate. So we're all familiar with that 6.2% that comes out of our paycheck every week. and sent to the government with our employers matching it, but it caps at 137,000 of wages. That cap is going to stay in place, but then the tax is going to be reimposed once you cross the 400,000 wage level. So that's where that additional trillion is coming from, creating a donut hole in Social Security withholding for individuals between or for less than 400,000. The other pieces of the individual raise comes from raising the top rate from 37% to 39.6. They're also going to cap itemized deductions at a 28% benefit. And they're also going to phase out the Section 199A, sometimes called the small business income deduction. We'll be talking about that later on. The last piece of it is the capital gains tax. So that was all long-winded way of getting to this slide. The capital gains increases is roughly 400 billion of that roughly 2 trillion of individual taxes that will be increased. And it comes in 3 pieces. It's going to be an increase of tax basically at the ordinary rate there, 39.6% for us real estate professionals, 43.4% for somebody that's owning passive stock of some sort. So that's going to come from the sales of capital stock investments and real estate. There's also going to be an increase in taxes because the capital gains rate is what's used to tax qualified dividends. So those of us that hold after-tax holdings in stock will have their qualified dividends taxed at 43.4%. And then lastly, when all of us go to meet our maker and die, any appreciation we have in our estate will be taxed at capital gains rate, which doesn't exist now. And Ed Reitmeyer is going to be talking about that later on, what we refer to as the loss of the step up in basis when we pass. The question then is, what would the obstacles be in Trump's proposal? So Trump's proposal, as I said, is basically just trying to get the capital gain rate down to 15% and keep it there and index it. I really think whatever Trump's proposal will be, if he were to be reelected, would be based on where we are with COVID and with the economy. And I think the same math and calculus will be applied by Joe Biden if he is to win as well. And that is, they have to wait and see to look where we are with both COVID and the economy. If we feel like we've got COVID under control and the economy starts to bounce back, then I think from Trump's point of view, he's probably going to want to come up with some additional amount of incentives via tax policy that will promote growth, similar to what he did with the Tax Cut and Jobs Act. And I also think that he will probably continue his desire to either have a payroll tax holiday or reduce payroll taxes, because that's the tax that hurts the lowest class of income earners in the economy, and that's what they want to get kickstarted. If we are still in a COVID lockdown situation, then I think you're going to see more stimulus packages, and that's going to be more just monetary relief to people, maybe some tax policy within, but it's primarily going to be stimulus. In either case, the obstacles for President Trump, if he were to win, would be dealing with, if he is, dealing with a democratically controlled Senate or House. And that's going to be a problem for him if they are in control. It's going to be a problem for him in terms of even if not in control, because he's going to have a hard time getting 60 votes in the Senate. So, however, if there is a dramatic need and definitive need for stimulus, then the Houses, whoever's in control, may come together on a bipartisan basis, as they did, as we saw in the CARES Act. So,
and Ed,
yes.
One of the things we've learned from recent history is that you actually need a law to eliminate the taxes. The president has deferred by executive order certain payroll taxes, but they have to be paid back, so that to actually get a permanent elimination of or permanent reduction, it does require a law, which requires both houses of Congress and the president.
Absolutely. So right now there is that holiday, but that's just a deferral, Wendy just said. But I think if there would probably be an appetite if you hear people talking about either a V recovery or a K recovery, with the K recovery meaning that the top end of the economy does well and the lower end does not do so well. If that truly is the case, I think there would be an appetite on all politicians from both sides to provide that relief to our lower income wage earners, because absolutely the Social Security tax is the most regressive out of all of our tax policies. All right, so then moving to the next slide, which is what would be the obstacles for the Biden administration. And again, I think this, again, the first issue that a President Biden would have to look at is where are we with COVID and with the state of the economic recovery, and that's going to drive things. Right. Aside from that, you have to look at the practicalities of getting legislation through the House. In the Senate or in the House, assuming that the Democrats retain control, that bill will pass easily. In the Senate, even if the Democrats do take control, they technically still need 60 votes. So assuming that, there would be 3 avenues for Biden to get his proposal through the Senate. One would be possibly through bipartisan support. We have seen that happen in the past, and I'm not discounting that. That could happen and maybe be a nice thing to see. If not, they could do it the way that the Tax Cut and Jobs Act was passed, and that's Wendy was referring to that. That's through a process we call reconciliation. And that's really why it took the Republicans, even though they were in control of both houses, a full year, because reconciliation means that the tax package has to fit a certain amount of expenditures that they've been appropriated from the Budget Committee. And there was a lot of Rubik Cube building to get that $3 trillion of tax cuts through, because that's all they could spend, which isn't normally how you pass legislation. And of course, the third avenue that we've already heard about is possible elimination of the 60-vote filibuster rule. And the Democrats have already at least floated that idea. So those are 3 ways that Biden could get his bill through. We already talked about the effective date. And again, I think that will depend. If it looks like we're still far away from recovery, it's likely that, I would say it'd be advisable that any tax increase or tax bill would be pushed off until we really start seeing the fruits of the recovery. Because as that one bullet point suggests, usually raising taxes in a bad economy or an economic downturn goes against conventional wisdom. In this bill, the taxes of $2 trillion on corporate taxpayers would clearly retard their growth, and the taxes on the upper incomes would stifle capital accumulation. And it's probably worth noting that 3 different economic modeling groups, the Penn Wharton Budget Model, the Tax Foundation, and the American Enterprise Institute, all scored this bill and projected what the impact long-term would be on the economy. And all 3 of them projected reduces long-term growth in GDP by between 0.2% and 1.5%. So that's
and
not a good thing.
I don't think there's a bill yet. I think there's a plan that would have to be reduced, of course, to legislative language. Is that right?
Absolutely, but all 3 of these groups are in the business of modeling tax changes, and all I'm sharing with you is that they projected that the long-term impact of this would reduce GDP. More importantly, Penn Wharton said it would shrink employment by 1 million jobs, Tax Foundation by 600,000, and actually the American Enterprise Institute projected 100,000.
I'm not quibbling with their projections. I'm just saying there's a plan there, just like there was for in the 2016 election, there were plans that the ultimate tax bill that was passed was different than the plans. You know, the plans are somewhere in the 3 or 4 page range, and the ultimate laws are in the hundreds of pages range, as the three of us can tell you. And so certainly if the entire plan is, you know, put into a bill and enacted, but at the moment we, you know,
Absolutely. Absolutely.
Yeah,
I agree totally. And I want to emphasize, and I think I stated at the beginning, that this is really just a president's way of pointing what direction he might be going. But it's worth, given that those groups did go through all the work to score it and project its impact. I think it's fair to share that with everybody. But let me just keep moving on, because I think I'm running a little bit long here. The next one is if an owner is absolutely convinced that the rate was going to increase, what would your advice would be? And I think I am going to actually pass on that, because I was never good at timing market moves. I would say that there seems to be an incredible amount of interest, though, assuming that people seem to be baking this in, a rate increase that is. You might want to be looking at your IRA and 401k accounts and possibly converting them to Roth accounts, taking the hit at taxable income now at a lower rate and saving you income taxes later on at higher rates. So, and then the next two very quickly. What about our carried interest, which is a main feature of most real estate deals, and that basically the elimination of preferential rates for capital gains makes carried interest basically ordinary income. So even though the section 1061 that imposes a 3-year hold right now in order to achieve capital gains, that will be redundant, because it's going to be ordinary income rates. And then finally on 1031, and this is the one, not from an individual taxpayer point of view, I am more concerned about its impact on publicly traded REITs. Although NAREIT, the industry leader for REITs, has a very strong lobby presence and has been successful in the past on hanging on to this. But I think it would significantly impact REIT taxpayers. As far as its impact on high net worth individuals, 1031s would slow down that option or prevent that option. But I think that clever or sophisticated or strategic tax planning can achieve the same result through partnership structuring, which is why we have Ed Reitmeyer and Wendy Cutzen doing structuring all the time for taxpayers. But partnership taxation structuring can achieve a lot of the results that a 1031 might do. And finally, the last slide, the 1031 elimination for elderly taxpayers. Again, that's going to dovetail into what Ed Reitmeyer will be talking about later on regarding general estate planning. But at least technically, the elimination of 1031 leaves the other options. One I just referred to is partnership structuring. There will also be opportunity zone investments, which we'll talk about later on, that can take the place of that. And of course, installment sales provides a deferral as well. So not quite as attractive as 1031, but at least options for those that have ability to structure as such.
Great. Ed Reitmeyer, any comment you'd like to make there?
You know, I think that one of the things, and kind of going back and talking about these different plans, is that candidates have to campaign, and they're going to campaign. And, you know, they start off with their primaries, and they play to their bases, etc. But eventually they get elected, and then eventually they have to govern. I haven't yet quite seen any elected official get everything that they've ever wanted that they've campaigned on. And I think that that's the magnificence of our style of government, where we have all these different checks and balances. So I think that I'm always an optimistic person that our government will be able to read the tea leaves and see that the pandemic and the economic stress that places are feeling are more paramount than, let's say, partisan politics. And I agree. I think that raising taxes is a drag on the economy, and especially when it's beaten down. The time that if you wanted to raise revenue would be when things were going better. That's just kind of my personal view on that.
And there's also obviously congressmen and senators who have strong views from both sides as to various industries. There are many senators who have strong views of the real estate industry, and it's one of the reasons that the real estate has done quite well in tax bills. So, you know, they get to vote for any plan that comes through. So we'll see how that all turns out.
Right. Thanks everybody on that. Now let's move on, and we'll let Wendy, if you could start us off. You know, let's just talk a little bit about what tax rules are most likely to change. You know, that would affect holders of real estate.
Okay. One of the things is the rates. The question is, will the top rate for ordinary income and capital gains go to 39.6 for those earning more than 400,000? That's yet to be seen. That would be of impact. Next slide, please. Real estate got the benefit of the 20% business income deduction, as Ed mentioned earlier. And that is due to phase out in 2026. It's part of all the individual tax benefits that are phasing out because of what Ed Leva described as the reconciliation process, so that they could get to the right number, and assuming it would ultimately be extended. But that's something that would affect for folks over $400,000 in income. And also, let's assume that there could be, and the impact on real estate owners would depend on, as the slide notes, the vintage of your real estate. If your real estate is older and depreciated and you have more income, the impact of the phase out or the elimination of the 20% business income would be greater. To the extent that there's bonus depreciation and losses available, it would have far less of an impact because there isn't the income, in fact, to reduce. So there's also things from the Tax Cuts and Jobs Act that you want to, keep thinking about. And there were CARES Act changes. That's the act that brought in the PPP loans and things like that. And so one of the changes made under the Tax Cuts and Jobs Act, which people probably are somewhat familiar with and is actually not a great thing, is the interest expense limitation deduction, so that generally interest is deductible only to 30% of what's called adjusted taxable income. There's a special rule for real estate that allows certain real estate to elect to avoid that, but the price of the election to avoid the interest limitation is spread out depreciation. As a general rule, that extended depreciation is not so terrible, so a lot of real estate ventures do elect out of the interest limitation. The CARES Act increased the limitation from 30% of adjusted taxable income to 50% of adjusted taxable income. And since this year is a bad year and it may not have taxable income, they're going to let you substitute your income from last year to measure the 50%. So that's an advantage. The depreciation changes that were helpful in the CARES Act included, so there was this big thing about qualified improvement property, which essentially is tenant improvements. Congress made a mistake when they passed the Tax Cuts and Jobs Act. They intended to allow expensing of qualified improvement property, but they forgot to, in essence, assign a short enough useful life to make qualified improvement property eligible. And the Treasury felt that it could not fix that by regulation or announcement. And finally, in the CARES Act, that was fixed. And so retroactively to 2017, qualified improvement property can be expensed, a very good thing for real estate. I'm going to mention also the carried interest. Another thing that came through in the 2017 Tax Act, it applies a longer holding period for carried interests. And it's something you want to think about if you want to dispose of property this year, whether it could, in fact, create ordinary or short-term capital gain instead of long-term capital gain. There are proposed regs. This is in the contest for the worst drafted provisions of the 2017 Tax Act. Carried interest is a particularly high-ranking section because it's totally unclear about what happens. And recently, Treasury issued regulations to explain, and just real generally and very high level, it matters what you sell. If you sell your partnership interest, you have a 3-year hold on the partnership interest. If you sell the property, it's a 3-year hold on the property. But if you sell your property and it's what's called 1231 gain for real property held for use in a trade or business for more than a year, then this rule does not apply to you. A very good result for real estate, which probably would get on the chopping block in a tax bill. The other thing that's available for deferral that came in the 2017 Act is qualified opportunity zones. And so this is supposed to be an accessible provision, but as it turns out, it's really complicated. But the gist of it is that if you invest capital gain in what's called a qualified opportunity fund, timely and subject to all the rules, you get to defer recognition of that gain until the earlier of December 31, 2026, where you dispose of your interest, and you can exclude part of it. You can exclude up to 15% of that gain if you hold your interest in the fund for at least 7 years on or before December 31, 2026, or 10% of your gain if you hold it for at least 5 years before December 31, 2026. So there's a discount. But the downside is that when you pay the tax on your rollover gain, you pay it at the then rate. So the rate in effect on December 31, 2026, whatever that may be. And the big benefit for qualified opportunity zones is that if you hold your interest for at least 10 years, then you don't pay any tax on any of the depreciation, which is just a wonderful benefit. And now a couple things to think about too is the Tax Cuts and Jobs Act eliminated 1031 like-kind exchange treatment for everything but real estate. But these days, I mean, if you're going to do a like-kind exchange of real estate and if it survives, then one of the things you have to think about is the bonus depreciation that's available. In the past, because depreciation on personalty and qualified improvement property was, spread out, it was certainly for the personalty, it was a reasonable position to take that the fair market value roughly equaled its tax basis. Well, when you can write it all off up front, it's hard to argue if it's not particularly old, that the book value, that the actual fair market value is zero. So that means some gain would be recognized at some point. Ed, do you want to talk about, Reitmeyer, you want to talk about suspensional losses?
Yes. So in the Tax Cut and Jobs Act, one of the items that they had was a limitation on the amount of tax losses you could take in any one year. You could have losses up to $500,000 for a married filing joint. And even if you had lost $1 million through depreciation, you were only going to be able to take $500,000 in any one year and then carry that forward. And what happened, and this kind of goes back to what Hillary was talking about in 2008, 2009, is that back in 2008, 2009, they used carryback claims as a way to add liquidity into people's hands, give liquidity to people's hands, especially developers. And so what they did in the CARES Act was that they eliminated the $500,000 limitation in 2018, 19, and 20. So immediately you could carry back. In addition, they allowed a 5-year carry back of your net operating loss. So you could, in 2018, literally go back to 2013 and make a claim for refund. And you can still do that currently. The two liberalizations of the loss rules in the CARES Act, the elimination of the excess business loss and the ability to do a net operating loss carryback, is something that has, at least for part of our client base, delivered significant tax-free dollars for refund claims back to our clients. It's really been terrific, especially in a case where they've been hoarding cash. But you have to be a little careful here in doing tax planning going forward. You know, would you be best served by not carrying back your net operating losses or your excess business losses and carry them forward? I think that's something that you have to take a look at. These, you know, global cash flows that the lenders require, I think you really need to think about what your tax plan is. As we discussed, you know, where your vintage is, and as Wendy just said, you know, if we're in a position right now where cost recovery happens so fast with our assets through bonus depreciation, that if we're a net acquirer of real estate, you know, we're going to have a lot of shelter. If you're a net disposer, you might want to think about moving that forward depending on the capital gains rates. But the loss carryback and the EBL is something that you really kind of need to take a plan for and decide really what's best for you, the individual taxpayer.
And one last thing to mention is the PPP loans, which are truly really wonderful, where you could borrow from the SBA, get money, and if you use it for appropriate purposes, it can be forgiven. And the Internal Revenue Code explicitly says, as amended by the CARES Act, that the forgiveness is not income to the taxpayer. But the IRS and Treasury have taken the position that if you pay deductible expenses with forgiven PPP loan, then you can't deduct those expenses. That sort of takes away a lot of the benefit. And there has been talk of fixing that in legislation. But so far, that's reversing the IRS and Treasury position in legislation. So far, not yet. I would not be surprised if that actually happens, however.
I think that would have to happen in somewhat of, obviously, in the next stimulus bill, because I think the IRS has got these, you know, years and years of cases about basis, whether you've got basis in these deductions or not. Also, as an aside on the PPP loans, is that there may be a quick rush to get a determination about having your PPP loan forgiven right away. You might want to, you've got plenty of time, right? You might want to just be careful in rushing back to some of these banks and some of these lenders' portals to do those applications for forgiveness. I think there's going to be more shoes to drop as far as information and how this is all going to come back. I mean, literally, it's something that changes on a week-to-week basis as far as the rules and regs as far as PPP forgiveness is concerned.
Those are really important issues, and that is some tremendous detail that you all have provided on that, and certainly things that are important to think about. Just for our last few minutes here, I think it's important that we hit on the two certainties of life, the intersection of death and taxes. And there may be some pretty significant changes afoot. Ed Reitmeyer, what are some of the important things that owners of real estate and, quite frankly, people in general should be thinking about with respect to estate planning as they look at a potentially changing environment?
Yeah, thanks, Randy. I think that you're exactly right. Death and taxes, they're two certainties that are going to happen. And I think when we take a look back and, we look back over the last 10 or 12 years, is that literally the real estate industry has gone from the, a horrible situation where there was distress everywhere, and to people that were able to hang on and manage their real estate correctly have made great fortunes. Those fortunes are going to be subject ultimately to estate tax. And whether or not there's a change in the president or there's a change in Congress, the current law of $11,580,000 per person is going to sunset in 2026. And what's that going to sunset back to is $500,000 plus inflation. But politically, and as some of the developers and such may feel like they've got targets on their backs in some of these cities as far as getting entitlements, etc., is that I think the same thing is going to happen with wealthy families, is that they've had this window of time where we have no callback rule, and to do your estate planning and to do it this year or do it as quick as you possibly can. And one of the items that you could do is, and I think in the 2 slides from here, right? We have certain 3 slides where it's planning techniques for a depressed economy. Is that these are all the different type of things that you should be speaking with your estate advisor, your accountant, your lawyer, to talk about how to transfer your wealth. If you don't have $22 or $23 million of net wealth, that's not really the time to start. I think that if your family's got over $5 million of net wealth, now is the time to start, because those numbers are going to change. We have a low interest environment, we have a depressed economy, or we can do depressed valuations. We also have certain rules that are helpful, right? The politicians will talk about raising taxes, etc., but there's these little nuances in the tax laws that allow you to have nice tax breaks. And one currently is that the gifting of partnership interest still allows for a marketability discount that we can use. And typically, when you are doing this type of estate planning, you're not talking about what I'll call the MAI appraisal. Well, that's important, is that you really do need to get an appraisal of the partnership interest which you're gifting. And that's really what will be moved out of your estate. So there's ways to use leverage in order to reduce the value, the net value of what that gift may be. I would line your estate planning up now and start to work on it, because the end of the year is going to get here quicker than you can. And I'm going to tell you the estate attorneys and the appraisers are going to be really full, and to get on their dance card is going to be really important. What you might ultimately use and what properties and what partnership interests, that probably could be determined after an election if you feel that the tax policies will change significantly. So we can't do this quick enough. There's kind of a saying that the only people that really do pay estate tax are the lazy and the cheap. I can tell you that in this case, for me, the shoemaker's kids have good shoes. My wife was all over me in March and April to make sure that the estates and the wills were all taken care of. I think that's really good advice. The other thing too is almost everyone's estate plan, if you have an estate plan, has a presumption that you're going to get a step up in basis. And I think you're going to have to relook at that possibility that you won't get a step up in basis. And just watch the political tea leaves on that.
And I mean, on that, the thing that has prevented that from going through each time is record keeping, at least as regards existing properties, because people have no idea. I mean, someone dies and a lot of people don't have sufficient records to determine basis. There's been laws trying to put in place for stocks and bonds, what original, so that it's reported,
Yeah.
but there's still a lot of property out there that no one could possibly have any idea what the basis was. And so there still is some concern in passing a law that they just couldn't get there for existing property and would have to apply it in the future.
You're right, but the noose is tightening because we're going to start to be required to report tax basis on all these partnership interests going forward. And just like on the brokerage statements where you're going to have to report basis, you're going to start seeing this in all of the partnership tax returns on a go forward basis. So at some point in time, somebody's going to get called on the carpet on this. But I think you're right. The record keeping is brutal, and that's why they made those changes years ago for people's residential properties, just giving them a $500,000 exclusion.
That record keeping question is interesting. When would you see that being phased in, that basis is reported on returns?
For partnerships returns, it's already started.
One other thing to emphasize on the estate tax matter is I don't believe the Biden plan has anything in it that suggests that the exemption will drop to a lower amount. And what people have speculated is they'll just let the current Tax Cut and Jobs Act provision run its course and allow it to just drop back to 5 million index for inflation in 2026. And that's really just people trying to handicap what they think may or may not happen as a result of an official bill once it does start going down through the legislative process. In reality, the increase in estate taxes by lowering the exemption, traditionally when they score it in terms of tax revenue, raises very, very little additional revenue in the grand scheme of things. And primarily that's because just on the base of our economy, driven primarily by income taxes, it's not a big amount. And also because most people that do have the wherewithal to plan around it can avoid it through proper estate planning,
Yep.
whether the amount is 11 million or 5 million.
Right.
Yep. And the sunset will be the path of least resistance. But again, a lot of this the tax policy is political in nature, and that's kind of an easy one for people to take a shot at.
True.
But you're right, it's a small sliver.
Okay, our time is up. Thank you, everyone, for your expertise. I'd really like to thank Ed, and Wendy. That was very enlightening and informative. There's a lot to think about as it relates to this. And thanks to our partners, clients, and friends who joined us today. A recording of this will be posted shortly to Berkadia's website, and copies of the slides will be available shortly as well. If you have any questions, follow up, please don't hesitate to contact your Berkadia professional with follow up, and they'll point you in the right direction for a resource with contacts and whatnot. That's all for today. We hope everyone and their loved ones are safe and well. Goodbye until next time.